Hello everyone, welcome back to my channel. Today we will continue with the chapter The Balance of Payment and Exchange. That chapter we will continue. So in the previous video I have already uploaded the meaning of balance of payment, then what are the components of balance of payment of current account and capital account, then what are the components of balance of payment. I have made column and I have showed you which are the items that is coming on the receipt side or the credit side and which are the items that is coming on the payment or on the debit side. Everything I have explained on the previous video. So those who haven't gone through the video, please go through it, and this is a continuation of that video, part 2 video, which I am going to discuss it today. So today I will be discussing with the what is this capital account transaction. Last class we have already done with the current account transactions. We have already discussed about the items of the current account transactions. So today we will discuss about the capital account transaction. So what is this capital account transaction? You see here, it is refers to the capital receipts and payment. When the resident of a country borrow from abroad, we are saying they are importing capital. Okay, that means when any resident, suppose the residents of a country are borrowing from abroad, that means they are earning, that means they are importing foreign exchange. They're importing foreign exchange. So this would be recorded where? This would be recorded on the credit side of the balance of payment. Why it will be recorded on the credit side? Because it is receiving the foreign exchange. So any foreign exchange received, that will be recorded on the credit side, which we have already discussed in the previous video. And on the other hand, when the resident of a country invest in abroad, that what we are saying, they are exporting capital. And here they are exporting capital when they invest abroad, that means they are exporting capital, and so that item would be recorded where? On the debit side of the balance of payment. Okay, that means when they are borrowing from abroad, when any resident of a country borrowing from abroad, that means they are importing capital, and this will be recorded on the credit side. And when they are investing in abroad, that means they're exporting capital, and that would be recorded on the debit side of the balance of payment. Okay, next we'll see the categories of balance of payment. What are the categories in the balance of payment? First we'll see balance of trade. Next we will see the balance of current account. Third we see the balance of capital account. These are the categories in the balance of payment. Okay, so balance of trade is what? Balance of trade shows that the balance of export import of visible good. Visible good here means the goods which are tangible good. The goods we can see, the goods we can feel it. Those are the tangible good. That means what is balance of trade? Balance of trade only will show the balance of export and import of the visible good. Only the goods which are visible, not the services, only the visible item. And services, it is not visible good. It refers to the difference between the value of good exported and the value of the good imported. The difference between it is recorded here. Now, if the country's export is greater than the import, what we can tell? That it is a favorable balance, or we can tell there is a surplus in the balance of trade. And on the other hand, if the import is greater than the export, what we can tell? There is a deficit in the balance of trade. So what we can tell? What is balance of trade? In short, we can tell export of good minus import of good. This is the balance of trade. Next, we discuss about the balance of current account. What is this balance of current account? It includes the visible, invisible, and transfer. Here, all the goods are recorded, whether it's a visible, whether it's invisible, or whether it is transferred. Okay, current account measures all the payments made for currently produced goods and services and non-trade flows. Here the non-trade flows include what? Interest, profit and wages. These are the non-trade flows. And also the your transfers. Okay, balance of transfer. It is also recorded here. So that means balance of current account is what? It recorded both the visible, invisible, and the transfer. Okay, here in this case, what happened? The payment, the current account measures all the payment for the currently produced goods and services and also the non-trade flows. And this non-trade flows include the interest, profit, and wages. Next is balance of capital account. What is this balance of capital account? It refers to the borrowing and lending from abroad and sale and purchase of asset and foreign exchange from the other countries. Okay, what is this capital account? It refers to what? Borrowing and lending from abroad and what? Sales and purchase of assets and foreign exchange from the other countries. Okay, now there are two types of this capital account, capital flow. First is autonomous capital flow and second is accommodating capital flow. What is this autonomous capital flow? It takes place with the motive of earning profit, dividends, interest, and other income. Okay, now if the Americans are investing in India, that means what is the objective of this America? Just to earn the profit. So that will be go on what? Autonomous capital flow. And what is the accommodating capital flow? It brings the balance of payment. It brings balance of payment into equilibrium. So balance of payment will be in equilibrium. So if there's a deficit in the balance of payment, this deficit will be settled by this accommodating capital flow. By using this accommodating capital flow, what will happen? Your deficit will be settled. Now, what is this balance of payment? Balance of payment here means include the total debits and credit relating to the all the accounts of a country where it makes the payment and also receive the payment from the rest of the world. First is what? It makes the payment and also it receives the payment. Okay, and balance of payment is always in equilibrium. Okay, balance of payment will always be in equilibrium, but it happens that balance of payment may be deficit or surplus. It may happen. Okay, so this much for the today's class. In the next class, we are again going to discuss what are the causes of the balance of what are the causes of the adverse balance of payment. If there is a disequilibrium is if there is a deficit or if there is a surplus in the balance of payment, what will happen? Generally, if there is a deficit in the balance of payment, what are the reasons for it? Obviously, if there is a deficit, that means there will be an adverse effect. So, what are the reasons for it? We are going to discuss in the next video. So, those who haven't subscribed to the channel, please subscribe it and thanks for watching.